Hello and welcome to the podcast hosted by myself, Louis Kessinger, and my dad, Tommy. We are a part of the Kessinger Lee Group at Baird and have been serving investors in our area for 4 generations. Our goal is to start a conversation around topics within the world of finance and to educate you, our listeners. All right, welcome back to Ticker Talk. We are back and we're going to be reviewing the second quarter. We're recording this on June 28th. So we do technically still have
we're a day shy.
A day of trading to go, but we have a pretty good picture of where we are. And so we're going to jump right into it and discuss Q2. Thanks for coming.
Yeah, thanks for coming. And yeah, we feel confident doing this even with 1 day to go because I always say, the market can only go down 4% before the circuit breakers kick in. They turn the machines off and send everybody home.
Yeah.
So,
it's not a very cheery thought,
no,
but it is true.
It is true. So you got that going for you. But, it's crazy. When last we met, for those of you that actually watch this podcast, when we last met, we were a few days into the second quarter discussing the first quarter, and it was so important because of the Liberation Day. The tariff tantrum, and the just absolute total 1 week roller coaster that we all went on.
Yep.
And yet, now here we are, 90 days later, the days are longer.
Yeah.
It's warmer outside.
A lot warmer now.
Yeah. Guess what? None of that mattered.
Yeah. We're back to where we started. And so to give a super quick rundown, if you didn't catch last episode or you haven't turned on the news in the last 3 months, basically what happened from April until now is that on April 2nd, we got tariffs announced, blanket tariffs on
everybody,
the whole world, essentially.
Everybody, everything.
And so we had an idea that we were going to get 10 to 20% tariffs on everybody, and that turned out to not be the case. We had a formula that was somehow made by somebody that announced tariffs on every country in the world, including a country that had no people. There was a country of penguins, a little island out there.
You'll pay too.
Yeah, and so we tariffed them, which was good. And then the more serious part, we got into a bit of a back and forth with China, and that's where a lot of goods come from. And the peak tariff rate that we got to with China was 145%.
Yeah.
And it didn't seem like either side was going to back down. And then we got the pause. We got the 90-day pause.
90-day pause.
And I believe it was 8%. I'm directionally accurate, but basically the market opened and we were flat. And that was 10, 12 days after the Liberation Day?
No, it was 8 days.
8 days.
I'm telling you, it was 8 days. It was
8 days.
This was so fast.
It was a week.
1 week later.
It was a week. And so 8 days later, we get the 90-day pause.
Right.
And there's a whole lot of talk about what that was, but doesn't really matter because the market went up and it was at the blink of an eye. And so then moving on from there, the market continued to recover from, we didn't quite hit down 20% bear market.
18, down 18.
But we were really, really close, and it looked bleak. And now here we are, 1 day from the quarter close, and as of Friday's close yesterday, we hit new all-time highs.
Yeah.
So that's the super quick version.
Record high S&P 500, record high NASDAQ. The Dow is a different duck, so we'll just leave that there.
Yeah.
But all of that, by the way, a week ago, had we done this a week ago, we would have been talking about geopolitical, the bombing of Iran, a sovereign country. We've flew bombers across the world overnight, hit 3 potential nuclear sites in conjunction with Israel, and crippled or decapitated or obliterated their nuclear capabilities. And here we are 7 days later, and so far, no real reprisal from that. So, very strong in terms of market sentiment.
Yes.
So
and the reason that is
please.
because although it was a lot of talk on, hey, we don't need to get involved in any more wars, and this is not a endorsement of either side of the coin.
No.
It's just what happened. It was, hey, we don't need to get involved in any foreign conflicts. But then there was Iran and Israel, and they were quite literally trading bombs for 12 days. And then we flew in B-2 bombers 36 hours straight and like you said, crippled their nuclear capabilities. And with the exception of a couple of performative shots being fired after the fact, there hasn't been any noise from either side afterwards. And so hopefully that's over.
Yeah, at least that's cooled off. And to say it a different way, the markets are not reacting to it. So it may or may not be over from a political landscape, but it is over as far as the market, the stock market, financial markets are concerned. Always with an eye to what's going on there. So, there's all these things. In the last 90 days, we've had all these things. And oh, by the way, the Federal Reserve has met a couple of times. Yeah. And they have left rates unchanged. At this time. So on the short side of rates, we're still looking at 4.2 to 4.5 is their target rate on 60 to 90-day T-bills. Yeah. So, in the face of elevated rates, the market has pushed all the way back. And part of that has to do with first quarter earnings came in really good. Yeah, and
very strong.
Second quarter earnings, which we will get the information on that here in July, are sizing up to be pretty decent as well. There have not been a lot of pre-announcements of, hey, we're not having a great 90 days here, to the point where now you're midway through the year. Now you're starting to look at, well, what are earnings going to be next year? Yeah. And next year's estimates across the board from multiple people are looking at about if the S&P 500 was its own entity, then the aggregate.
And if you own an index of the S&P 500, this is important to you.
Yeah. So if the aggregate of those earnings are going to be about $300 for the index, so that's a big number. Put a 20 on that. 20 times 300 get you 6,000. We're at 6,000.
Yeah. Here we are. And so that is you hear people say, "Oh, that's priced in." So Here is what the market is pricing in for those $300 earnings. It's pricing in, hey, a calm down of the geopolitical situation. So that's good for market prospects. Hey, we're going to be able to continue dealing in an international way with countries around the world. There's hopefully not going to be an all-out war in the Middle East, so that's being priced in. The other thing that we just talked about was interest rates, and though they have remained unchanged to this point, to the chagrin of the administration, the Fed has said, hey, we are still looking at collectively likely 2 interest rate cuts before the end of the year, and that is stimulative, and that is being priced in to the earnings of the S&P. So that's kind of why things are starting to really align a little bit.
And don't forget about the big, beautiful bill.
And the big, beautiful bill.
So we've got there's a bill working its way through both houses of Congress. It's worked its way through the House of Representatives, is now in the Senate. They're making their mock-ups and changes and amendments to that bill. And at some point here, probably in the next week, there will be a vote as to whether that passes. The passage of that has been priced into the market. The market, stock market, collectively, believes that bill in some form will pass with these permanent tax cuts on businesses. Yeah. And that is a key to those $300 in earnings.
And not just on businesses. It is proposed to keep a lot of the tax cuts in place from the 2017 Tax Cuts and Jobs Act from the first Trump administration
on individuals. So then you take that out and you go, oh, so people will have the same amount of money in their pockets to spend. If this bill goes away, then they would have, in theory, less in their pockets to spend. Businesses would be taxed at a higher rate. So now your 300 maybe comes down to 250. So that's not priced in at all.
No.
Okay, Louis, did you know?
No.
What is the best at the S&P 500? The best month for returns.
Okay.
In the market.
Okay. Full disclosure, we had this discussion earlier, so I'll tell you my guesses originally. I originally guessed April. If I remember, that was tied for third.
Up 1.5% on average.
And then I guessed December.
Up 1.5%.
And my thought process there was, Christmas, you've got the consumer out spending, and hey, I'll refrain, or I'll put myself in check in January. I'm just gonna
spend
go
it all
out in December, and so that was my theory there. But I think that was also tied for third.
Tied for third with April.
And then I guessed May, which was not a great guess, really.
No, it wasn't.
And then I knew it wasn't October. That's kind of a bad omen for investing. For whatever reason, a bunch of bad stuff happens in October. Not always, but there's several big dates in October, so I knew it wasn't that. And then you finally, after I guess half the months on the calendar,
you were running out of months.
You revealed to me that it was
July.
It is July.
So the month that we are heading into for the last 100 years, according to our friends at Ibbotson, who do these kind of statistical studies, July has averaged up 2%. And it makes sense. The days are longer. You feel good. You're on vacation. You're probably not even thinking about the market, so nobody's selling. So now that doesn't mean there's not volatility, and that doesn't mean that whatever.
It's not a prediction for July.
Yeah, that's
either.
not a prediction, and it also doesn't mean that whatever you're holding probably could go down 10% or what have you. That's an average of 500 stocks over 100 years. Yeah. So again, and then followed by August is up 1.2%. So this stretch, the 2 months, the 2 month span has been the best 2 month span over the last 100 years. And then that all changes in the fall. But, here we are going into the beginning of the third quarter and with a nice tailwind, and earnings will start to come out the mid part, July 15th through basically August 26th. And so if the earnings continue to come in well, it should be nice.
And so one thing that you touched on a little bit was, so a lot of times when companies are not doing well, they have what's called basically estimates. So during earnings season, you have, the Wall Street estimate for earnings for this company, for earnings per share, for revenues, all these different projections that quote, the street is predicting. And what we haven't seen is companies say, hey, we're going to revise our estimates down.
Right.
And we haven't seen that. And so you're having all these things align, and there isn't an actual timeline on the big, beautiful bill of July 4th, but there's a self-imposed deadline.
Yeah, we'll see.
Of July 4th. We're getting dangerously close.
Clock's running out on that. We'll see.
But I would think that we would have an answer one way or the other around July 4th.
Correct.
So that puts us going into earnings season or in the middle of earnings season when we're going to see that passed or not in some capacity. But there's still a lot of elected officials who want to make some changes and different things within that bill. So we'll see how that shakes out as earnings approach as well.
And then there's another component that we need to touch on here just for a few minutes, and that is the people that make all of this run.
Yeah.
And that's the consumer.
Mm-hmm.
And so stock market's feeling good.
Yeah.
Right? 401k statement you're going to get early next month feels good.
Yeah.
News cycle is a little weird, but you know,
it always is.
Overall, it's fairly calm, and yet the consumer is like not buying it.
Mm-hmm. Yeah, the consumer. So the UMich, University of Michigan Consumer Sentiment Survey came out for the month, and it actually came in at 60.7, which is an arbitrary number if you don't keep up with the survey, but that's lower than almost any point. Well, than any point last year, and the lowest since 2022. And if you remember 2022, we entered a bear market. The markets were really not good. Inflation was ramping up. We were having to raise
headed
rates.
to 9% on inflation.
And so if you look at 9% inflation and a bear market in 2022, we're sitting here at 2.8% inflation, and we're positive on the year at new all-time highs. So to your point, the consumer is calling a bluff a little bit. But at the same time, they're still spending money.
Yeah, but the math isn't mathing. And what I mean by that is that the headline official inflation gauge that the Federal Reserve looks at has been at or below 3% for 12 consecutive months. And yet, in this Michigan survey, the consumer believes inflation will be 5% in the year ahead.
Yeah.
Now, there can be lots of reasons for that. It is a survey, so let's just be clear.
And one thing that we talked about in an episode that we did is that there's a difference between Wall Street inflation, which is what I would call, the CPI and the surveys
PCE
and all that, and Main Street inflation, which is how the consumer is coming and what their frame of mind is when they come and take these surveys. Like, hey, 9% inflation, I didn't feel it as much then. It's now caught up to me.
Yeah.
Everything is more expensive. Gas is more expensive. Rent is more expensive. Food is more expensive. There are a lot more people cooking dinner at home now. And instead of, for a while, it was kind of a, hey, is it more expensive to eat out or is it more expensive to cook at home? Especially if you've got a family.
Right.
Or, hey, I cooked a meal for 4. There's only 2 of us. I didn't eat the leftovers. That was just as expensive as going to O'Charlie's.
Yeah.
So you're now seeing inflation, the real effects of it hitting your wallet catch up, and the consumer is feeling it,
pulling back.
And at the same time, in 2022, 21 through 23, really, the other thing that the consumer had the benefit of was, I can just go get a new job.
Right. Yeah.
That is not true today. No. Now, we haven't entered into there being less jobs yet, but it is much harder to job switch and to find a new job.
Yeah, you need to keep the job you got.
Yeah.
And my golden rule for you and your brother and your sister was never quit a job until you've got a new one ready to go.
If possible, obviously.
If possible,
If
that's your choice.
Right.
So said differently. But a couple of things on that note. So as you're looking at the markets, and we'll sort of look at the quarter ahead, but one of the things I always look at is if you've got unemployment at 5% or below, and we're 4.1% unemployment, remember to flip that. Always remember to reverse that and go, that means 95% of eligible working people who want to work are working.
Right.
Or 96% in this case are working. And my favorite time to make a move into the markets is when they announce that there were more jobs created than expected, and the market sells off because it's scared that that's somehow inflationary. And I'm sitting there thinking, but everybody's going to pay their rent, and they're going to buy an iPhone, and they're going to buy a car and pay for gas and get growth. I'm like, don't forget to take the numbers and reverse them and think logically like, oh yeah, more people working is good. We just talked about earnings being higher. That accelerates those earnings.
Yeah.
So, be sure to watch for those things. That's what I like.
Yeah, the short-term news cycle can be very weird in that you can turn it on and you'll hear the talking heads say things like good news is bad news or bad news is good news in this instance. And it may be for that day. But in the long term, if more people are working and wages are rising, that's a good thing.
Yeah, earnings have to go higher in that respect. So just be thoughtful. Remember, stay diversified, stay invested, stay on your plan. Stay on your plan. I mean, if that, be sure to really evaluate those things and always evaluate your sleep at night number. If you have enough in your sleep at night number, the rest of it can go through the
and it's okay, like you said, to evaluate that number. Yeah. You don't have to say, hey, I need 10 grand and then freak out as you only have 10 grand and you want 20 in cash.
Right.
Because staying invested in some capacity is the most important part, because when you get the 90-day pause and you're not invested because you're freaked out, you just missed 8% in that day, and you probably now just missed new all-time highs.
And there's no way to get back in. It's very difficult.
Lots coming in Q3.
Yep. Stay
like
tuned.
We said, we've got earnings, we've got the big beautiful bill, and who knows what else. So thanks for listening. We'll see you next time.
All right.
This podcast is intended for informational and educational purposes only. It is not an offer to buy or sell or solicitation of an offer to buy or sell any security or investment or to participate in any particular trading or investment strategy. The information is considered to be from reliable sources, but its accuracy is not guaranteed. We do not offer legal or tax advice, so please consult your tax or legal professional for information specific to your situation. The opinions expressed are those of the speaker and not necessarily those of Robert W. Baird & Company Incorporated. Please note, past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. You should carefully consider investment objectives and risks of any investment before investing. An investment cannot be made directly in an index. Securities and investment advisory services are offered by Robert W. Baird & Company Incorporated, a registered broker-dealer and investment advisor, member NYSE, FINRA, and SIPC. You should consider the investment objectives, risks, charges, and expenses of each money market fund carefully before investing. This and other information is found in the applicable prospectus for the money market fund. Contact your Baird financial advisor for a prospectus. Please read the prospectus carefully before investing. Money market funds are managed to maintain a stable $1 share price. An investment in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund.